Good afternoon or good morning, everyone. Thank you for joining this Nadex webinar. It is the second part of a two-part series on short-term price action at Nadex. In part one, which we did last week, we covered binary options. This week, we are going to cover knockouts and call spreads. If you were unable to join last week, that session was recorded and it is available both on the Nadex website. On the website, if you go to nadex.com, you can go to Learning Webinars. And if you look in the archive, you'll find the archived recorded version. You'll also find it on the Nadex YouTube channel. I would encourage you to subscribe to the Nadex YouTube channel. And if you weren't aware, every morning at 8:45 a.m. Eastern, 8:45 a.m. Eastern, for 15 minutes, we live stream and do a quick update on what happened overnight, what might be happening during the day, where are some potential hot spots, where might there be some volatility, and we do a little technical analysis. So I'd like to point out the Nadex YouTube channel. So go to YouTube, find Nadex, subscribe to that channel. Now, people are going to ask, is this session being recorded? And it is also being recorded. So if you have to drop out or you want to re-review this session, you'll be able to do so again on the Nadex website under Learning Webinars and look in the archive. You'll also find all of our upcoming webinars. You can register for those, as well as the Nadex YouTube channel. All right, as I mentioned, this is a two-part series. Before I jump into it, all of our webinars are sponsored by our compliance department, so I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And lastly, this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I'm doing this for your education purposes. Now, when I go through the slideshow prior to this presentation, that's going to be easy enough, but I will be doing an off-roading session afterwards. I like to talk about the concepts, and then I like to show you, do a practical demonstration. When I do that, I'm not making any trade recommendations. I'm simply demonstrating the concepts so that you're able to connect the theory to the application. So I'm trying to make it as easy as I can for you to bring you up to speed. And today it's going to be knockouts and call spreads. So what are we going to cover? I am going to do a brief discussion on who is Nadex. I like to do that these sessions mostly because we have so many thousands of new traders coming into Nadex markets. I like to just do a brief little lesson on who is Nadex, and I'm going to keep it brief because if you joined last session, I did cover it there. Then I am going to go into knockouts, and I'm going to define them, and I'm going to talk about how they work. If you're not familiar with the term knockout or how these work, you will after this. In fact, I find knockouts to be our most intuitive product, and I think you'll like knockouts and how they work. And we'll talk about the risk, the reward, and the capital requirements. How much money do you have to trade a knockout? So I'll make that all very easy for you. Now, once we cover knockouts, if you understand knockouts, call spreads are very easy to understand, which is why I cover knockouts first. And then, as I mentioned, I will be doing a very practical demonstration. Now, as we go, I would encourage you to type in questions. You've got a little question box on the bottom right-hand side of your screen. In fact, it would be great if somebody wanted to type in now. We've got a pretty good group of folks. When I do the example, when I do the demonstration, is there a particular product you'd like me to cover? Gold happens to be pretty popular now because there's volatility in it, and the inflation picture is getting a little murkier, or maybe a little bit more clear in what the Fed's going to have to do about inflation. But type in a product, a foreign exchange product, or just say FX, and I'll use FX pairs. Or put in a different commodity. We can use oil, or if you really just want to be looking at the stock markets, maybe one of the equity indices. So if you can, it would be really helpful. Just type in a product. I will try to use that. And there we go. The first answer, by the way, that came in was gold. So the winner goes to gold. I am going to use gold as an example when I'm talking through it. And then when I actually, and more of them are coming in, when I go to the platform, I will also show some examples, particularly of the equity indices, because I know that is actually where a lot of people like to find that short-term price action, and these knockouts are really they're geared for all of our products, but I find that people really get into them and leverage them, particularly in the equity indices. So we'll look at the S&P 500 as well as the Nasdaq. All right. Oh, by the way, I like to, and more, I love it. More of them are coming in. I will try to use all of them. Now, I like to put this up front. I don't want to bury this. It's something that not many people are, for some reason, aren't familiar with. If you are new to Nadex, or even if you've been around Nadex for a while, we do run a refer a friend program. And if you've got a live account, it's only if you have a live account, you get your own customized link. I can show you where that is in the platform. If you share that, you can copy it and share it with your friends on social media. You can email it to them. But a, a lot of our traders like to trade in little groups. They like to trade with their friends. So if you invite your friend and they use your link to join Nadex, and they place 5 trades within 30 days of applying for their Nadex account, we'll give them $100. We'll give you $100. It's what is that? It's like Oprah. You get $100. You get $100. Everyone gets $100. You could do that with up to 10 friends, which means you could end up with $1,000 if you have 10. If you find 10 of your friends to join, they'll each get $100 to trade with in their account. You'll end up with $1,000. It's a great way to trade with your friends. Make this a little bit more of a social experience, because traders do help each other. So something I like to put out there early on. Now, I am going to quickly cover who is Nadex. It is an acronym. It is an acronym for North American Derivatives Exchange. But what I really like to point out is it is a regulated exchange. We are regulated. I probably should put in the name for CFTC, Commodity Futures Trade Commission. The CFTC is a U.S. regulatory body. It is the same regulatory body that oversees all of the large futures exchanges in the United States, like the CME, the Chicago Mercantile Exchange, or ICE, the Intercontinental Exchange, who owns the New York Stock Exchange. The reason I like to mention that, mostly because of our binary products. Not necessarily knockouts and call spreads, because knockouts and call spreads are a little bit unique to Nadex, but our binary products, there are other binary option providers out there that are not regulated. And in that case, I say caveat emptor, buyer beware. If you needed some type of recourse and there were a challenge or a problem like getting money out of your account, it's one of those things that I hear all the time. Oh, those binary options exchanges, they'll take your money but will never give it back. We are regulated by the United States government. I mean, we've got to adhere to all the rules, laws, regulations of the United States. There is none of that weird, nefarious behavior going on at Nadex. We are a proper regulated exchange, unlike many of the other binary option providers out there. All right. The one thing that this is important, specifically to knockouts and call spreads as well as binary options, is we design products for the individual retail trader. There have been a flood. I mentioned there's thousands of new traders at Nadex. Retail traders have jumped into the markets. We've seen about it in the news. One of the cool things about Nadex is we have designed these contracts, and we designed them years ago, so we were ready for it. Very low cost of entry, and every one of our products has defined risk, meaning you can never lose more than you initially put into a trade. There are no surprises. Generally, a surprise is a negative thing when you're trading. At Nadex, you know exactly what you're getting into, what you could potentially make, what you could potentially lose before you enter trade. So things like initial maintenance margin calls, losing more than what you have in your account, losing more than what you have, period. That's simply not going to happen. It can't happen. We've got small retail size trades, notional value. You do not need thousands of dollars to trade at Nadex. You could do so with tens of dollars or even hundreds of dollars, depending upon which product it is. But it is designed for retail traders. And we've got a lot of folks who are wanting to get into the action and simply haven't had that wherewithal or the ability to get into the markets and trade because they were precluded from doing so because of the risks and the size and the amount of money required. At Nadex, we have solved that problem. And that's why retail traders come to Nadex. Now, let's get into it. What are knockouts? All right, we are going to cover knockouts first. And again, I would encourage you, if I go too quickly over something, please type in a question. I will try to answer them as I go. I will definitely look back at the questions at the end to make sure that I answered all of the questions. You've got me here now. So please leverage me as a resource. And it's highly likely that if you have a question, somebody else also has a question. So what is a knockout? A knockout is a contract. So that's the very first thing. It's a contract and it has a set price range. And that price range is between two levels. Those two levels are the floor and the ceiling. So there's a low price level, we call it the floor. There's a high price level, it's called the ceiling. Okay? And the value of the contract will trade between the floor and the ceiling. So since gold was the very first one, I'm going to use gold. And I think gold is around $1,830 an ounce, $1,830 an ounce, ballpark, somewhere in that vicinity. So we might have a contract and it'll have a floor below 1830. It'll have a ceiling above 1830. And there are different levels. We'll talk about that. But there'll be a floor and a ceiling. And the value of a knockout will trade between the floor and a ceiling. Now, knockouts are what I call Delta 1 products. Now, that's a fancy term. What is a Delta 1 product? It means it will move directly in line with the underlying market. So if the futures contract on gold is trading 1830, the value of the knockout will be 1830. If gold is trading at 1825, the value of the knockout will be 1825. It is our most intuitive product, and I'll explain. And when we get into call spreads, you'll see what the difference is. Or when we talk about binary options, for instance, which we covered last week, there you're trading the probability that the contract will finish in the money, that it'll finish as the statement being true. And if you don't know binary options, you can go back. But that's what you're trading. You're trading a probability when you trade binary options. We'll get into call spreads, but knockouts, Delta 1, it is just like any other product that you're probably used to trading, like a stock or whatever it is that you trade. If you think it's going up, you buy it, and if you think it's going down, you sell it. Now, you're going to, the very first question I usually get here is, wait a minute, I don't own gold. How can I possibly sell it? And that is the nature of this being a, quote, contract. Remember, this is a contract. So you're not actually trading gold. We're trading a contract on gold. So, excuse me, I got a little bit of a cough. When you're trading this, you're trading the price of gold, but when you buy it, you think the price of gold is going higher. You're not buying actual gold. You're just taking a long position on the price of gold. And when you sell it, you're simply taking a short position on the price of gold. So if you thought the price of gold were going down, you can sell a knockout. You're not selling gold. You are simply taking a short position on its price, looking to speculate that the price would go lower. So Delta 1, very straightforward, and you've got a floor below and a ceiling above. Now, let's talk about how they work. A knockout will expire. There are two ways that a knockout will expire or settle or finish. And the two are price or time. All right, so let's first talk about price. That is a price triggered settlement. That is the price of the underlying index, the underlying product, so the gold, touches the floor or the ceiling. So when you're trading a knockout, you've got a floor and you've got a ceiling. If it touches the floor or the ceiling, that contract expires, it settles, and it's over. It's a price triggered settlement. So if you were to buy a gold knockout and it went down, it went against you and it touched the floor, you would get knocked out and you would experience maximum potential loss. I bought it. I thought it was going to go higher. It went down. It touched the floor. I am knocked out. I've experienced maximum potential loss. On the flip side, if I bought a gold knockout, I thought it's going to go higher. It does indeed go higher, and it goes all the way up to the ceiling. It would touch the ceiling. I would get knocked out of the trade. That is why it's called a knockout. You are knocked out. You touch the ceiling, you're knocked out. You've experienced maximum potential profit. Now, if gold were to keep going higher, you couldn't make any more on that particular trade. But on the flip side, if you bought it and it went down, you couldn't lose anymore. You know what you could potentially make and what you could potentially lose before you enter the trade, because you know what the floor and the ceiling are around the price when you put the trade on. Now, if I thought gold were going to go lower, I can sell it. If I sell a knockout and I'm correct and it goes down and it touches the floor, yes, I did the right thing. I am knocked out of the trade and I've experienced maximum potential profit. And if I sold it and it went up to the ceiling, I would get knocked out for maximum potential loss. So that is why they're called knockouts. You're trading, it's a Delta One product. You are trading the price of the underlying. It'll move right in line with it. And you've got these levels above and below where you would get knocked out of the trade, where the trade would settle, and you would either experience a profit or a loss. Now, the other way that a knockout can expire is by time. Knockouts are weekly contracts. We set them up as weekly contracts. So at the beginning of every week, we set up some knockout contracts, and as time goes on, some of them will get knocked out, and I'm going to go through the process, and then we'll add new contracts. But at the end of the week, whatever contracts are still open, they will settle. It will settle at the end of the week. So if you buy or sell a knockout and it does not touch either the floor or the ceiling, it will settle. It'll settle at a price between the floor and the ceiling, in which case your profit or loss on the trade at the time triggered settlement will be the difference between where you bought or sold it and where it settled. So if you bought or sold a knockout, it doesn't touch either the floor or ceiling. It will settle at a price at the end of the week, and you will have experienced a partial profit or a partial loss, depending upon the price where you bought or sold it and the price where it settled. Seems pretty straightforward. Again, I told you these are probably the most intuitive contracts we have, and I think they're the easiest to understand once someone explains them to you, just because they have some buzzwords, some terms in there. Now, let's talk about how knockouts work, because I just mentioned that each contract has a maximum duration of a week. And at the beginning of the week, we will list 4 knockouts for every market. There's a reason why we do that, and I'm going to get into that a little bit later. And it has to do with risk reward, and it has to do with how much capital you want to put up at risk. Now, when a contract touches a floor or a ceiling, that contract is expired, and we will list a new contract, so that generally speaking, there will always be, hopefully, 4 knockouts for you to choose from. Now, I'm going to walk through a simple example in a little bit of a graphical form so you can see how it works. Here's an example of the US 500, of the S&P 500, and it doesn't matter what price I use, but at the time it was trading 27.20, and we build 4 knockouts around that. Knockout number 1, the way we do this, and this is for S&P 500. For other markets, the spreads might be a little bit different, but they're all roughly relational in terms of the impact of the move. But in the S&P 500, we'll take the current price, we'll go down 10 points, just 10 points, and we'll make a floor, and we'll go up 40 points and make a ceiling, so that you've got a spread in there of 50 points between the floor and the ceiling. Then we'll make knockout number 2 a little bit different, where the floor is a little bit lower and the ceiling is a little bit lower. And we'll do the same with knockouts 3 and 4, so that you've got 4 knockouts to choose from. And again, I will explain why we've got 4 knockouts. But let's just walk through the mechanics of what happens. Here's the market at 27.20, and there's expiration at the end of the week, and we're going to see what happens as the S&P 500 moves. It starts going higher. All right, from the moment that this started trading, it went higher. Now notice, when it went higher a little bit, the ceiling of knockout number 4 actually got touched. All right, so we've hit the ceiling of number 4. What happens? Knockout number 4 is settled. It's over. If you had bought knockout number 4, it went up a little bit, you made some profit, you're knocked out. If you sold knockout number 4, it went up a little bit, you lost some money, and you got knocked out of your trade. Now, what happens? Knockout number 4 is gone. Since it was going a little bit higher, we added a new knockout, which is a little bit higher in the market. So once again, you've got 4 knockouts to choose from, all with roughly the same distance as we initially had between the floors and the ceilings. Now let's take a look at what happened if it started trading lower. All right, so the same situation, but instead of going up, the S&P started going down, and of course you can see right there, it hit the floor of knockout number 1. It hits the floor of knockout number 1. Knockout number 1 is knocked out. It settles. All right, it expired. That one's now gone, and because we are going lower, we will add a new knockout down below, so that you've got 4 knockouts to choose from. Now let's take a look at time-triggered settlement. And this is a little bit of a buzzword, that knockouts are variable payout contracts, because it's not a defined amount whenever you trade a knockout. It's going to depend upon where you bought or sold it and where it ultimately settles, whether you get knocked out or whether it settles in between the bid ask. Between the floor and the ceiling. I'm sorry. If it settles between the floor ceiling, here's an example where at the end of the week we had these 4 knockouts. These are the ones that existed. The knockout settles at the end of the week, and let's say, for instance, knockout number 3 or 4, your profit or loss would be the difference between where you bought or sold it and where it ultimately settled. Now, why do we build knockouts this way? And we specifically built knockouts this way because what it does is it essentially forces you, before you enter a trade, to have a trading plan. When you learn the basics of trading, this is the very first thing people will say is, have a plan. Have an idea of what you think might happen. What does your analysis tell you? And put some parameters around that. So with a knockout, you know before you enter a trade what your maximum risk is and what your maximum potential reward could be before you enter the trade. All right? And essentially what that does is that floor and the ceiling give you very defined risk control boundaries. Right? And what that is if you buy a knockout, that ceiling is your profit target. That would be your ideal situation. What am I looking for? Why did I choose this knockout? I bought it because I thought it was going to go to here. That's where I would want to get out for a profit. That I want to pick a knockout where that ceiling gives me the most potential profit for what I'm trying to accomplish. But it also gives you a stop loss level. If you're wrong, if you buy a knockout, that floor is going to be, oops, I was wrong. I wanted to limit my risk. I might not be in front of the computer when it's moving around. I mean, we have to get up and move around sometimes. In fact, people put on knockout trades and they can potentially walk away knowing that if some anomaly were to happen and it were to go against them, you bought it and it just plummets, you know that if it touches the floor, you're out. You know exactly. If you sold it and it were to skyrocket, you know where you are stopped out. There's no slippage. There's no, ooh, it's touched a level. Now I'm going to try to exit that trade. No, it touches the floor. It touches the ceiling. That knockout is settled. It is knocked out. And you do have that stop loss baked into your trade. Whether you're buying or whether you're selling, you can limit your losses to a level that is comfortable for you. And then you've also got your profit goal. Where would you get out for a profit? These are things that a lot of traders have a very difficult time determining. Where do I set a stop loss? Where would I get out for a profit if I'm right? And you should have an idea of that before you get into a trade. What a knockout does is it forces you to have those levels baked into your trade before you enter it. Now, on the risk reward side, this is pretty intuitive. I'm not going to go through this slide a lot. The risk is if you buy it, it's the difference between where you bought it and the floor. If you sell it, it's where you sold it and the ceiling. That is your risk. And your reward is the exact opposite. And I put this in here intentionally for people who are going back and reviewing this, or if they're just simply reading the slide deck and they wanted the slide deck and they were going through this deck and they were just reading it without listening to the rest of the presentation. I wanted this to be in there that when you buy it, you're looking for it to go to the ceiling. If you sell it, you're looking for it to go to the floor. That would be your rewards. Now, I want to show you a graphical example because I think this also helps resonate. How do you choose which knockout is best for you? And these choices can be a little tricky or cumbersome or confusing to some people. So I like to be able to show a very clear graphical way of representing what you're getting into in terms of risk reward when you trade a knockout. So in this example, this is that same example I had earlier, and we are simply going to look at knockout number 1. And this is an example of buying a knockout. Now, why did I choose knockout number 1? All right, and let's just take a look at that. Here's the price of the S&P. Here's when I'm buying it. Here's the end of the week. Here is the floor. All right, when I bought this knockout, I chose knockout number 1. Knockout number 1 had the highest floor. So it's what I would call the one with the tightest stop. The one with the tightest stop. It was the one that was closest to the floor, so that if I bought this and it started going down, this is the one that had the least amount of risk in it. Now, the ceiling, that would be my profit goal up above. Here's where I bought it, all right? This is where I bought it. I don't know if it's going up or going down, but graphically, I can see this red section down below. If I were to buy this knockout, that's my amount of risk. I know what it is and I could see. Now, how much reward could I potentially have would be the entire green area. So what you're doing is you're choosing a risk to reward ratio that suits your trade. How much am I willing to risk? What are my potential hopeful profit goals? And where do I want to balance that? That is one of the reasons why we have a variety of knockouts. Some people want to have very, very tight controls on their losses. Others are willing to take a little bit more risk because they wanted to give a little breathing room. If I were to buy this, how unfortunate would it be if it just dipped down, touched the floor, knocked me out, and then took off and went up? Now, if it did that, you could always get back into the trade and buy it again. There'll be a new knockout for you to buy. But some people just would rather have a little bit what I call wiggle room. They want to have a little bit more wiggle room, so they might choose the second knockout where there's a little bit more risk in it. The red area might be a little bit bigger, but my green area will be a little bit smaller. This is reason number one why we provide 4 knockouts for you to choose the balance between the risk and the potential reward that suits your trade. Now, I want to do the same thing on the flip side, just so you can see if we were selling. If I were selling, I might choose, and again, let's say we were going to do the one with the tightest stop. Well, what's the one with the lowest ceiling? The one with the lowest ceiling is knockout number 4. So let's take a same setup. Here's knockout number 4. The ceiling is very close. I'm selling it. I'm looking for the S&P to go lower. I want it to trade lower. I know exactly where I sold it. And if it were to go up, that is my risk. All right, when I'm selling a knockout, now I've got a little bit of risk, but my potential reward would be that green area. So one of the reasons that people use knockouts, they keep that risk parameter as low as they can, and they look to buy a knockout where it's closer to the floor. They look to sell a knockout when it's closer to the ceiling to keep tight risk controls, tight risk parameters in the event that you're wrong. It also will then give you the largest potential profit. If you're right, it'll give you the most room for it to run in your direction, whether it's up or down, for you to make profits, potentially make profits. Now, this is the second reason why we offer a variety of knockouts, and it is about capital requirements. All right, so since you know the maximum you could lose before you enter a trade, and this goes all the way back to the beginning of this presentation when I said Nadex builds contracts for the retail trader where you don't need large quantities of money because every product has defined risk in it. We know the amount of risk in a knockout before you enter a trade. If you were to buy it, it's down to the floor. If you were to sell it, it's up to the ceiling. And since we know what the maximum risk is, that is your capital requirement. That capital requirement will never change. If you buy a knockout, you buy it, you're buying a price. We know beforehand what you could potentially lose because it could go down to the floor. That is the amount that you have to put up for the trade. That is your capital requirement, and you can manage and you can look at the different knockouts. How much am I willing to risk? That's how much you have to put up. Now, that's what's cool about that is once you do that, that will never change. I mentioned that there are no margin calls ever because there are no margin calls ever. When you buy a knockout, you know how much risk you can have. You put that in. That is it. You can never lose more than that. If you sell a knockout, it's up to the ceiling. You know how much you can lose. That's what you put up when you initiate the trade. That amount will never change. Right? You will never get a margin call or a maintenance margin call. They simply don't exist at Nadex. There aren't any surprises. You know what you're getting into before you enter a trade. You can simply, that's what you have to put up when you put on. And it doesn't matter whether you're buying or selling, since we know what that risk is, that's what you put up. Now, what does that do? Because we give you 4 knockouts, you can choose also. So reason number 1 for having 4 knockouts is for you to choose the risk reward profile that suited your opinion. All right, how much am I willing to risk? And it's also allows you to minimize your capital requirements so you can make best use of your capital. If you don't have a lot of money to risk, you can choose the knockout with the lowest amount of risk, and that is all you will have to put up. If you're willing to take a little bit more risk and you want to have that wiggle room in the event that you're wrong so you don't get knocked out, so that you have time to potentially be right, you would have to put up a little bit more capital, right? Because you're taking a little bit more risk, but you can choose based upon how much capital you have to trade, how much capital you have to invest. You can choose the knockout that both suits your risk reward profile as well as your financial situation on how you want to make efficient use of your capital. So knockouts allow you to make efficient use of your capital by allowing you to manage the amount of risk you have on a trade. Right? And good. And I think I answered that question. Excellent. If anyone's got any more questions, please typing them in. But I think I got that one covered. Now, I would like to quickly cover an order ticket on a knockout, and then we're going to jump into call spreads. And now that you understand knockouts, call spreads are going to be easy to understand, I think. Now, on an order ticket, you will get an indicative price in the upper left-hand corner. By the way, in the upper right-hand corner, you will see time to expiration. And here's an example of the NASDAQ, the US Tech 100. And notice right there up top of the order ticket, it gives you the range of this contract. The floor, 1352. The floor, 13,052, and the ceiling, 13,202. So there's a 150-point range in these knockouts, and it tells you it expires at 4:15 in 3 days and 21 hours. Now, there will be a bid-ask spread on the order ticket. You'll see those prices. By the way, in the upper left-hand corner of the buy and the sell, that's the number of contracts available at that price. So that's the quantity. People will often ask that. But there's the bid-ask spread. And you'll notice the bid-ask spread, 1372 and a quarter, 1374 and 3/4. And notice that that is right around the current indicative price, 1374. That's generally what you will see with knockouts. That's what I mean by delta 1. The price of the knockout will trade right around the current indicative price. Now, if I wanted to buy one, I'd have to pay $1374.75. If I wanted to sell one, I could sell it at $1372.25. Do I have to trade on those prices? No, I can use a limit order. We have a central limit order book. Anyone can put a price that they would like to trade in the order book. You can put a bid, you could join that bid at $1372.25. I could put a bid below. Hey, I'm looking to get this. If it dips down, I'll buy it a little bit lower. I can put one in between. And in fact, here's an example of me putting one in between at $1373.50, just below the current indicative price. You can place an order there. Now, are you necessarily going to get filled? Will you necessarily trade at that price? Not necessarily. Someone else has to want to trade with you. So if you put a bid out there, that bid will show up, and you would see that underneath the sell side because that someone else could sell it to you, and you would see your bid $1373.50. And if someone wanted to sell one, they'd have to sell it to you. First come, first served. So you can put a bid or an offer in between the bid-ask spread if you want. Not guaranteed to fill, but if you were to buy one at $1373.50, we tell you on the order ticket right up front, if you were to buy it at $1373.50 and it dropped down and touched the floor, you would get knocked out and experience an $86 loss. Now, if you were to buy one and it were to run all the way up to 13,202 in the next 3 days and 21 hours, you would get knocked out with a $514 profit. Pretty straightforward. You're buying or selling a price. It is delta 1. It should move right in line with the indicative price, the underlying, and the price of the market will generally be right around that indicative price. You can trade on the markets with a market order, or you could try to trade, put a bid below or an offer above, or put one in between the bid-ask spread. Maybe someone else will want to trade with you. But you can do that, and you know what your maximum profit or maximum potential loss are before you enter the trade. That is knockouts. Let's quickly cover call spreads, and then I want to jump over to the platform. Now, the reason I say call spreads are so easy to understand once you understand knockouts is because they are very, very similar. A call spread is also a contract, and it also has a predefined range, and that range, also the low price is called the floor, the high price is called the ceiling. And the value of a call spread will trade in line with the underlying, similar to, but not the same as knockouts. And there are two very big differences between call spreads and knockouts. All right, there's two differences. Now, these differences, and this is why the price will be a little bit different for a call spread. Number one, a call spread only expires at expiration. I'm going to say that again. A call spread will only expire at expiration. So if you buy or sell a call spread and it touches the floor or the ceiling, you are not knocked out. You are still in the trade. So if you buy a call spread and it goes down and it touches the floor, you're not knocked out. You still have time to potentially be right and for it to come back up and go higher for you to potentially profit. The only way a call spread expires is at its expiration time. So a call spread will trade until expiration. Now everyone's like, that's really cool. That's so much better than a knockout because, hey, I've got time. But you have to realize, so there is no price triggered settlement, but that optionality will come at a price. There is going to be a premium. There is going to be a premium baked into the price of a call spread. So it will not be exactly a Delta 1 product. While a knockout is Delta 1, what you see is what you get, and it will move right with it. Because there's optionality with the call spread, I buy it and it goes through the floor. I can't lose any more than what I initially paid. All right, I can't. I know what my risk is when I buy it. It's a defined quantity up front, but that price is going to include a premium, and volatility in the product and time to expiration will impact the amount of that premium. If there is a lot of time left in a call spread, that premium is going to be a little bit higher. If there's a little time left, that premium will be much lower. And if there's a lot of volatility, if a product is flinging all over the place, that will increase the price of the premium. And if it's pretty stable and it's low volatility, there'll be less of a premium. But you will see the premium that you pay, the extra that you would pay, more than what you would pay for a knockout. And if you were to, and I'll show you some examples, you will pay more for a call spread than you would for a knockout. And when you sell it, you'll have to take a hit on the price that you sell it at, because of that volatility. I sell it and it goes up and touches the ceiling. I'm not knocked out. I still have time. I'm still in my trade for it to go back down. That optionality is going to come at a price. Now, the order ticket looks the same. There's an indicative price, 13,070. This is again. Now notice in this example, there was only 21 hours and 49 minutes to go. So there's a full day to go. Now take a look at if I wanted to buy this, all right, the current indicative price is 13,070. And it's, right now, call it 13,112. There is 42 points of premium. All right, this is not a Delta 1. Notice, this is where it's currently trading. It is currently trading below the market. All right. In fact, the bid is someone's willing to pay 13,108. And it's already, it's below, it's down at 13,070. You would have to move 38 points for this to be a scratch, right? That is the premium. That is what I'm talking about. You will pay a little bit extra. Now, again, I can put a bid in between. If I were to pay 13,112, right between the bid ask spread, I know that I could lose $168. That's the most I can lose. I couldn't lose any more, and I could potentially make 232. Now, I will tell you that optionality in call spreads does cut both ways. If I buy a call spread and it goes up through the ceiling. All right, it goes up through 13,170. I am not knocked out of the trade. I'm still in my trade. If I want to get out of this in the next 21 hours and 50 minutes, I would have to sell it. So if it were to go up and I'm profiting and this is great, I'd have to sell it to get back out. And what could happen? It could go up, and if I'm not paying attention, it could come all the way back down and I would have missed my opportunity to profit. So I am going to show you how you could set a profit goal on your call spread. If you bought one, you could put a price in to sell it higher. And if it does trade up and you're not looking, you could potentially get taken out of your trade and say, thank you very much, I made a profit, knowing that you can't lose any more than what you initially put into the trade. Your losses are limited, but at some point you might want to lock in your profits. A lot of traders will do that. In fact, that brings me to an important rule when trading knockouts and call spreads. And if I don't have your attention, if I lost you along the way, I'm ringing a bell. This is true for binary options. Pay attention. This is absolutely important when you're trading binary options, or if you're trading knockouts or call spreads. Right? Just because there's an expiration associated with these contracts, they all have an expiration, does not mean you have to wait until expiration to see what happens. You can choose to exit your position early. Now, with call spreads and knockouts, why would you want to exit a position early? And there would be two reasons why you would want to exit it early. Number one, lock in that profit, particularly with call spreads. It goes your way and you're making a profit and you've got your profit goal. You might want to exit the position. You bought it. You might want to sell it at a price higher and exit and say, thank you very much, I made a profit. Or if you sold it, and you can set a bid down below. You sold it, you're looking for it to go lower. It does go lower in that call spread and it hits your price. You buy it back and you're locking in a profit. Thank you very much. All right. You can do that with knockouts as well. You don't have to wait. If you have a knockout, you bought one, you don't have to wait for it to go all the way to the ceiling or for it to get to expiration to see what happens. You bought it, it goes up, you've made a profit, you can sell it. Thank you very much. Move on to your next trade. You can also do it to limit your losses. You bought a call spread, you bought a knockout, it is going down, it is going against you. Now with the knockout, you know if it goes down low enough, you will get knocked out of the trade and that'll be that. With the call spread, it can go down. Remember, you still have time for it to come back. But at some point, you don't have to experience maximum loss. You don't have to experience maximum loss. If it's going against you, you can choose to simply liquidate your position, take your lumps. I bought it. If I want to liquidate a position, I just simply sell it back. I sell it. I'm out of the position. I take my losses. I move on to the next trade. If I sold one and I'm looking for it to profit, I want it to go lower, but it starts going higher and I don't want to experience maximum potential loss, I can go and simply buy it back, either a knockout or a call spread, and take a partial loss prior to expiration. And that is important. Managing your risk, a very important concept. So just because there's an expiration associated with the contract does not mean you need to wait until then to see what happens. You can choose to exit your positions early. Now, with that, if I think I've answered everyone's questions. I love that we've had an active audience, and I think I've been answering them as we go, which makes it super easy. If I've got any more questions, and I'm going to jump over to the platform now and demonstrate these. But if I don't get to something, please feel free to email customerservice@nadex.com. We are here to help. We want to see you successful. That's why I make myself available to answer these questions as I go. But if you have questions about our products, our markets, the platform, your account, please email customerservice@nadex.com. We are around to help. Follow us on social media. I mentioned our YouTube account. I would highly recommend go to YouTube, look up Nadex, subscribe to our channel. We are publishing content every single day. Our CEO, he's now our CEO. He's not our chief commercial officer anymore. A great job by Travis McGee. Really earned it. Really earned it. Travis is our CEO. He does a brief 1 minute. It's a bit motivational, a bit inspirational. It's early in the morning, and he just does a quick little recap, quick hits, real quick hits of what's going on in the markets and what you might want to be paying attention to. And then 8:45 a.m. Eastern, 8:45 a.m. Eastern, every day we go live. We live stream on YouTube and we do a deeper dive, 15, 20 minutes, probably very similar ideas or concepts that Travis might have mentioned. We might have a little bit more information because we do it a little bit later than he does his. And we take a look at what's hot in the market right then, what to be looking at for potential opportunities that day. We do record those immediately. So if you can't catch them at 8:45 a.m. Eastern, they're immediately available in the live stream section. You'd have to go to past live streams. They're also available on our website. There's a pop-up in the lower left-hand corner on our landing page. I probably ought to show that. In fact, I probably will, where you can just click on it and it will show you the latest recording. It'll also show you when you could join. So if you can't find it on our YouTube channel, on our nadex.com, right on our homepage in the lower left-hand corner, there's a little pop-up that can help you both join and see it and follow along live, or catch the recording, the most recent recording. All right, with that, I am now going to jump over to the platform. I do want to do a demonstration and let you see this in action. As I like to say, my mom was born in Missouri, however you want to pronounce it, the show me state. I find that a lot of this makes sense when you see it in action. Okay, so I am going to start with knockouts on the platform, and I am not doing a full-blown platform section right now, but what I will say is we do have some tutorials. We do sessions. We do them. I know we do it minimum one a month, but we've got plenty of platform education out there. Right now, I just want to show you knockouts and call spreads. So in the knockouts, you'll see that little button on the platform in the upper left-hand side panel. And you know what? I see gold, I see US 500. I'm going to try to show you a little bit of an FX. I'm going to try to show a little bit of everything. So let's start off just quickly, because I'm on gold. Because I'm on gold right now, we're going to go to commodities, and you'll see we have different commodities. And when I open it up, you'll see these indicative prices. We know these are all weekly. When I click on gold, you will see 4 choices. There should generally be 4 knockouts for everything. Initially, it doesn't matter which knockout I click on to populate a chart. I am now going to move this away to give us a little bit more room. And the reason is, on the left-hand side of the chart, we make it very easy for you to see the 4 different knockouts. We put them right in front. I mean, you can switch between these by clicking on these vertical blue lines on the left-hand side, and it will draw the floor and the ceiling. So if I thought gold were going to go lower now, all right, it's done a rally, I'm looking for it to turn over, I might choose the knockout with the lowest ceiling. If I wanted to take a position here, I would sell it. If I click sell, all right, I've got an order ticket on the right-hand side. If you wanted to see market depth, by the way, you could click and see market depth. And notice the indicative price, 1834.86, which is right around, I mean, this knockout, it's a dime wide. It settles in a day, 1834.80, 1834.90, right around the indicative price of gold. If I thought it were going lower, I could sell one. Now, if I sold one at 1834.80, I know I'm risking $72. If it touched the ceiling, I would get knocked out, and I'd be looking for it to go all the way down to the floor. Now, if I wanted to place an order, I mean, God, it's difficult for me to place one. I can't even place one in between the bid-ask spread. They're one pip wide. So I couldn't even, but if I wanted to join the offer, 1834.80, I want to place one there, I can place my order, and you'll notice that the amount there went from 9,000 to 9,001, and I've got an order down here. I'm trying to sell one at 1834.80. Now let's just say I wanted to go ahead and sell one at 1834.70. I just want to, oh, look at that. I actually traded it. I now have a position. Perfect. Yeah, it went bid, and that's interesting. Okay, good. So I actually sold one. All right, I sold one. I've got now. Notice that my profit or loss that it's going to calculate is based on me exiting the position right away. All right, meaning I just sold it at 1834.80. I If I wanted to close this, I'd have to buy it back right at that price, and I'd have no, now I'd have to pay. You're watching this tick around a dollar, a dollar, a dollar. We do have this close functionality that's available where it would close it at a market order. If I click close, it will send a market order and it would close my position. I don't want to close my position. I want to leave that open. I'm going to go back to the chart. All right. And yeah, now notice, okay, yeah, I sold one and now I've got hey, I could buy it back. Nope, look at that. It's just bouncing around a little bit. Okay, which is fine. Now, I sold one, 1834.80. Do I have to wait for it to come down to 1792 to take my maximum potential profit? The answer is no. I know that I'll get knocked out at 1842. It goes up to 1842 and I will get knocked out and I would experience maximum potential loss. But if I wanted to take this off at a partial profit, and I'm just going to pick a spot, a point here on the chart. Let's just say I'm looking for it to come back down here to 1820. That is, 1820. Could I put a bid down below at 1820? And the answer is yes. I would simply click buy. I put in my price, 1820. I want to buy it all the way down at 1820. All right. Now I know I'm already short one from 1834.80. I want to buy it back at 1820. I can place my order. All right. Now you see in my order book, I am trying to buy one down at 1820. Okay. And I would take a partial profit down below if it were to turn over and roll over. Now, if it were to keep going higher, I know I'm stopped out. I've just put a different floor on my trade because that's just where I'm willing to take it off. And I know that my risk is capped up above. Now, do I have to sit around and wait and see what happens? I could decide, whoops, I made a mistake. All right, I want to get out of this trade. It's going against me immediately. Maybe I don't want to risk all $72. Let me cancel. I'm going to go ahead and cancel my bid below. I'm going to delete that. I'm going to go back to my positions. I'm losing. It's going the wrong way, right? And I do want to just simply close it. I can close the position. I would experience an $8 loss, now a $9 loss. You know what? I didn't mean to do that. Close my position. I closed my position. I took an $8 loss. I'm out of the trade. And there we could see it in my history where I sold it. I bought it back. Whoops. I was wrong. And I've got no position on. And I can make a different determination on what I want to do next. So do I have to experience maximum loss? No, I can exit a trade early. Do I have to wait for it to get all the way down to the floor if I sold one and hope for all of that profit? I may want to, I may choose to do that, but I can buy it back early and lock in profits beforehand if I wanted. Now, I'm going to jump over and let's take a look at some of our call spreads. All right, and I'm going to look at call spreads let's go to the S&P. Let's go take a look at some of these. And we have call spreads on a bunch of different equity indices. Here's the Dow Jones, the Wall Street 30, US Tech 100s, the NASDAQ. We got someone who had asked for the S&P 500. So we're going to go ahead and use, let me notice how this we have different time frames. For knockouts, they're all weekly contracts. For call spreads, we have different expirations. It depends upon the product. For our equity indices, these are daily contracts. I'm going to hit refresh. We're going to get all of our new contracts. So we've got a couple of out. Well, this one's going to end in 18 seconds. That call spread. We'll do it again, and I'll refresh again in 15 seconds, and we'll even get the new set. But we've got, every hour, every couple hours. Here was the daily contract that launched last night. So you had that available last night. This is the one that launched this morning. And there, we just expired. So I'm going to go ahead and refresh this. Oh, it might take it a minute for these to, there it goes. There's all of our new ones. The expired ones are gone. Let's just take a look at some of these call spreads. in here. All right. Now, again, I'm just going to pick any call spread for the S&P 500. I am now going to move that out of the way. On my chart, I can see the different call spreads, and they are in a shaded region. Now, if I thought this were going to roll over, let's just see what the ranges are, and it's the shaded region. All right, it's just the shaded region. This call spread is way down below. This call spread's way down below because it's moved. This one might be a little interesting. If I thought this were going to go lower, I didn't want to. Let's pick this call spread. No, not that one. This one. There we go. All right, now we are currently above this call spread range, but I'm looking to sell it. All right, now it's currently the indicative price for the S&P 500 is 44, up near 44.19, 44.18. Notice if I wanted to sell it, it would have to be in the 44.12 range. Okay, so it's got 6 points of premium in that. Down, I'd have to sell it down at now, do I know what my max, if I were to sell one at 44.12, what's the most I could lose? I could risk $29. I'm risking 29. And what could I potentially make? I can potentially make 271. And what am I looking for here? I'm looking for it to drop down. Notice it's red because I'm taking a short position, and I would have to sell this. All right. Now, if I thought it were going to go higher, all right, I probably wouldn't buy this contract, all right, because all I can make, all I can make would be $24, and I'd be risking 270. I might choose a different call spread. Here's one where we're near the floor, all right. So maybe I'd want to buy this call spread. I think we're going to rally into the end of the day. It's got 3 hours and 12 minutes on the S&P 500. Now, if I were to buy it, we're currently at 44.19. Right, I'd have to buy it at 44.22, so I am having to pay up a bit. So this is not a Delta One. There is a little bit of a premium in this product. Could I buy one here at 44.22, looking for it to go higher? I can't. I could try to. I'm going to place my order. All right, I placed an order. And you can actually see I've got an order over here. There's my bid, my one lot. We'll see if it ends up trading. Who knows? Hey, I actually ended up buying it. Now, what am I risking? I'm risking $70. I cannot lose any more than $70. My maximum potential profit, 230. I need this to rally higher. Now, we can currently see we're at 44.19. I am paying a little bit of a premium. I paid 44.22, but you know, this is what I'm hoping to profit if I want. All right. Do I have to wait until expiration to see what happens? No. Maybe I'd sell this at 44.30. All right. In the middle of this range. If I wanted to try to sell one at 44.30, I can put an offer up above. I am placing an offer higher. All right. I'm placing an offer higher, and I could place that order, and that order. Oh, wait. You know what? I was on the buy side. See, that is a mistake. Notice now I've actually got 2 of these. That's an important lesson. I want to sell one up at 44.30, and I should have noticed that because it was blue, not red. I want to sell one at 44.30. All right, so now I'm willing to sell one. Maybe I'll sell one up there and I'll keep the one I just bought. I placed the order. So now I actually own 2 of these. Where did I buy that second one? I bought the second one at 44.22.30. Okay. All right, that's okay. So now I've actually got 2 of these. My average price, 44.22.15, and I'm trying to sell one of them up at 44.30. And if it gets up to 44.30, I would sell one of them. I'd still have one that might run a little bit higher, but you can trade out of these. Now, if I really am unhappy, I bought 2 of these. Could I just dump one of them? Could I just sell one back out? I could. You know, if I want to get rid of one, and what did I pay? Let's just take a quick look. I can't remember. I paid 44.22.30 on accident. I could try to sell one right back at that same price. 44.22.30. And I could try to scratch that one trade. Oops, I'd get out of one. And notice in my order book, I'm trying to sell one at 44.2. 44.2230. That would be a scratch on my error trade. Whoops. Maybe I'll just get out of it because all I wanted was 1, and I'm offering 1 up above at 44.30. Looking for that partial profit if this were to go higher. So you can place offers in between the bid-ask spread up above. I could place bids between the bid-ask spread down below. I can get out of a position early, either to lock in profits or minimize losses. I did go a little bit extra long, went a little over today, but I wanted to make sure I covered an example of both call spreads and knockouts. I want to thank you for joining me today. I want to thank everyone for asking. Here's a question: what time frames do I use for knockouts and call spreads? And you know what? That's a great question. What do you use on your chart when you're trading a knockout or a call spread? And generally, that'll depend upon the knockout or call spread that I'm trading. All right. So, for instance, let's go back to my call spreads. All right. And let's go to Forex. All right, now I'm going to look at, let's refresh this. Let's look at the Euro US dollar. I'm looking at call spreads. There's a call spread. These are the noon to 2 p.m. call spreads. Let's just pick one of them. All right, I'm going to hide this. This call spread expires in an hour. Now, let's take a look at where these call spreads are. I'm going to bring this chart in a little bit, and you could see the ranges. Now, would me using an hourly chart necessarily help me on this? And if I looked at a 1 hour chart, this is going to expire in an hour. I don't know. Is that going to help me some? Would I rather have a little bit more granularity and maybe use a 10 or 15 minute chart? That might help me a little bit more on my analysis, right? And again, it's the time frame of your trade matched to the time frame of your chart. If I were looking at, let's just go for example now to knockouts on Forex, the Euro US dollar. All right, I'm going to look at knockouts. This has got a day. Maybe I might not want to be using a 10-minute chart for these. I might want to be using a 2 hour chart. It might help me make a trading decision a little bit better on, let's just spread this out a little bit, on which knockout I might want to use for, and again, you could still do your analysis using different time frames. I could drop this down to hour or even 30 minutes. I could use a 30-minute chart. Even though this expires in a day, a 30-minute chart still might really help me in my trading decisions on which knockout I might want to use and how my technical analysis is showing up on how I might want to determine my trade. So that is an important consideration. What time frames you use on your chart. You might want to use, you can use slightly different time frames, but again, I would say consider how much time is left in the contract and adjust your time frame on your chart accordingly. With that, I want to thank everyone for joining us. We do webinars. We do a couple webinars every week. We do have another boot camp coming up. You can take a look on learning webinars, and I think it's August 10th. You can take a look how to day trade the stock market. And again, those morning analysis sessions every day, I would highly encourage you to join. It really does help you focus because sometimes you don't know exactly where you might want to be focusing on potential hotspots for that day. We live stream every day on Nadex YouTube. Thanks for joining, everyone, and I want to wish you all good luck in the markets.